Let's kick off with a look at state bonds over in Nigeria. There have been a lot of state bonds that have been issued in recent weeks. The latest being the 9 billion naira infrastructure development bond for the Niger state. This will have a 14% fixed rate, redeemable between 2011 and 2018. Just give us an idea of what type of demand we see coming through for state bonds and what type of demand you see coming through for this infrastructure bond.
What we've seen in recent times, we've seen investors moving from equities into government securities, particularly into bonds, particularly state bonds and the FGN bonds as well. What you find is that because of the state bonds having a higher coupon at issue, you find out that a lot of investors actually do buy these instruments. Some are worth their merit, some maybe the return or the yield maybe doesn't adequately justify the risk inherent. With the Niger State bond, the annual revenue of the state roughly is about 48 billion naira, of which about 13 to 15% is internally generated, and the remaining is through federal allocation. Obviously, we would like to see a bit more internally generated revenue. Over the years from 2009 to 2010, we saw their internally generated revenue dip by about 2 billion, from 8 billion to about 6 billion. So obviously that's not comforting as well. Yes, you're right, they're issuing a 7-year fixed rate, 14% infrastructure bond.
This is attractive. This is attractive, David. If you look at where inflation is under 10%, shouldn't it be?
Yes, it is. Compared to your 7-year bond, FGN bond, the spread over the sovereign probably is around 100 basis, about 150, 170 odd basis points. Compare that to a bond that we see coming out in the near future, like the Delta State bond. Revenue is about 155 billion. Of that, about 20% is internally generated. Internally generated revenue has grown by about 135%. Over 2-3 years. So we actually like that issue. Total revenue again is 155 billion. Issue size about tranche 1 is about 50 billion. The third largest naturally endowed state in the country. The third largest attribution to GDP of the country as well. So I think. And they're also at 14%. So comparing that to Niger State, I would rather, that bond, the Delta State bond, to the Niger State bond, in my opinion.
Let's then take a look at the sovereign bond market, because in September, the Nigerian federal government will be issuing 70 billion naira in 3-year, 5-year and 10-year sovereign bonds. As I said, that's next week, September the 14th. This has been a monthly occurrence. What type of demand do you see coming through, particularly in light of the heightened risk aversion we're seeing in global markets and, of course, local issues around heightened terrorism?
We expect to see oversubscription. We've been seeing oversubscription of between 150 and 200% in the federal government bond space, largely from pension funds, the banks as well. Don't forget, factors driving this are, number one, the banks' loan growth is still low. As a result, they're putting a lot of their cash in government securities. Then secondly, the switch in asset class from equities to bonds by institutional investors like asset managers and pension funds. And thirdly, you have insurance companies and some private investors as well, rather preferring to buy government securities rather than buying equities. So you're seeing demand coming through from those ends. We also expected demand from foreign investors, but that hasn't materialized. If you remember, there was the removal of the CCI restriction, the 1-year CCI restriction, and we expected that foreign investors would troop in.
Now, David,
what we've seen is...
Sorry, David.
Sorry, carry on.
We are running out of time, and I just wanted to touch on one other thing. We've seen a lot of demand coming through for fixed income assets in South Africa here, over in Kenya, the same in Nigeria. What type of issuance have we seen in the bond market when it comes to company bonds? And how would you compare this versus the likes of last year?
Definitely, we're seeing increased demand. That was what I earlier alluded to. We're seeing increased demand overall for state bonds, for company bonds. However, the company issues have been few and far in between. We haven't seen a lot of state issues. We're expecting a bond from UB at some point in the future.
Why is that, David?
Well, we would like to see more company issues in terms of state bonds and company bonds, and sizable ones as well. You know, I guess from an investor point of view, these bonds are illiquid and they're not trading. And once these issues can be fixed and there's a retail market, then I'm sure that more companies will come out to the market and more investors will be interested in these as well.
What type of spread in yields are we seeing between sovereign bonds, state bonds, and then company bonds?
What we see for a comparable maturity, say a 5-year bond, you would see your 5-year FGN trading at around 11.4%. You would see state bonds with similar maturity, probably between 13 and 14% for new issues, and you'll probably see company bonds around 14% as well for a comparable maturity. And the spreads from between states and corporates is largely zero, and that's because the risks typically are the same. You know, you would expect state bonds to probably rate higher, probably a AA, but with the corporate governance issues, probably corruption in some places, you find out that investors actually see these risks and price them in as well. And you find out that your state bonds also are A-rated bonds, and in fact, you have to have credit enhancements to sort of prop that A rating as well. So, but with a corporate, you would expect that they would have some form of corporate governance, some form of credibility and track record as well.